I want you to picture two coworkers. Same company, same title, same salary, same Tuesday morning commute, same coffee from the same machine in the same break room. They were hired the same year. They've received the same raises. Their paychecks, after taxes, land within $40 of each other every single month. Marcus is 45. He earns $80,000 a year. His 401k balance is $22,000. Not $22,000 contributed this year, $22,000 total. 15 years of working, 15 years of paychecks, 15 years of raises, and the number sitting in his retirement account is what a reasonably disciplined person could save in 8 months. He's not irresponsible in any obvious way. He doesn't gamble. He doesn't have an addiction. He has a nice apartment, a newer truck, a gym membership he uses 3 times a week, a decent wardrobe, and a social life that requires money the way all social lives do. He checks his retirement account maybe twice a year, usually when someone at work mentions it, and closes the app quickly because the number makes him feel something he hasn't found words for yet, a specific kind of dread that lives just below the surface of ordinary days. James is also 45. He also earns $80,000 a year. His 401k balance is $340,000. Same company, same title, same salary for 15 years. The difference between $22,000 and $340,000 is not income. It is not luck. It is not an inheritance or a windfall or a particularly brilliant investment strategy. It is 6 decisions, made differently, repeated consistently, over 15 years, and if you met both of them at a company party, you would almost certainly assume Marcus was doing better. He has the truck. He has the lifestyle. He has the visible signals of financial progress. But financial security is invisible, and the gap between looking like you're building wealth and actually building it is the most expensive gap in personal finance. Today I'm going to show you exactly what those 6 decisions are, not in theory, with real numbers, real math, and the real compounding effect of each one applied over 15 years.
I needed something
My
more
name is
flexible.
COLT, and by the time
A
we're
way to
done,
use my
you'll be able to
skills
look at your
without
own financial
sacrificing my
life and
evenings
know,
with the kids.
clearly and specifically, which side of this gap you're currently on, and exactly what to do about it. Marcus isn't behind because of one catastrophic mistake. He's behind because of a pattern so gradual and so socially acceptable that most people never notice it happening until it's been happening for a decade. Every time his income went up, his life went up with it. The first raise bought a better apartment. The second raise covered the truck payment that replaced the paid-off car. The third raise absorbed the lifestyle that came with a slightly better social circle. And now, 15 years in, he needs every dollar he earns just to maintain the life he's built around earning it. The lifestyle is running the finances. The finances aren't running the lifestyle. James made a different decision early. So early it barely felt like a decision at all. He decided that his lifestyle would not automatically expand with his income. Not because he wanted to suffer, because he understood, before most people do, that the gap between what you earn and what you need is the only real engine of wealth. Everything else, the investment accounts, the compound interest, the index funds, is just what happens to the gap when you protect it long enough. Rule 1. Automate the gap before you can spend it. When James got his first real paycheck at this company, he set up an automatic contribution to his 401k that came out before he ever saw the money in his checking account. 15%. Not the company match minimum, not whatever felt comfortable. 15%, gone before his brain had a chance to assign it to anything else. Most people intend to save what's left after spending. James spent what was left after saving, and the order of those two operations is the entire difference between $22,000 and $340,000 at 45. Here's what that math actually looks like. At $80,000 per year, 15% is $12,000 annually going into a tax-advantaged retirement account before lifestyle gets a vote. At a historical average return of roughly 8% annually in a diversified index fund, $12,000 per year for 15 years doesn't grow to $180,000. It grows to approximately $325,000 because of compound interest doing what compound interest does when you leave it alone long enough. Marcus, contributing sporadically, sometimes hitting the match minimum, sometimes skipping contributions during tight months, averaged closer to $1,500 per year into his retirement account over the same 15 years. At the same 8% return, $1,500 per year for 15 years grows to roughly $41,000. He has $22,000 because he pulled some of it out during a rough stretch in his early 30s and paid the penalty without fully calculating what that cost him long term. The difference between $12,000 per year and $1,500 per year isn't a difference in income. It's a difference in sequencing. James paid himself first. Marcus paid himself last, which meant he paid himself almost nothing, because there was almost nothing left. Automate the amount that matters before lifestyle sees it. Not the amount that's comfortable. The amount that, when you calculate it honestly, is required to actually reach the retirement you're imagining. Rule 2. Never let a raise reach your checking account at full value. Every time James received a raise, he increased his retirement contribution by half the after-tax value of that raise before the new salary ever hit his account. A $4,000 annual raise after taxes became $2,000 more per year going into investments and $2,000 per year in lifestyle improvement. He got to enjoy the raise. He just didn't let the raise disappear entirely into a lifestyle upgrade. Half went forward, half went now. Marcus received the same raises. Every single one went directly into his checking account and was absorbed by his lifestyle within 2 months. Not through any single large purchase, through the way life expands silently to fill available income. The slightly nicer restaurant becomes the regular restaurant. The modest upgrade becomes the baseline. The occasional luxury becomes the expected standard. And each raise, which felt like financial progress when it arrived, became invisible within a quarter because the lifestyle simply grew around it. Here's what 15 years of losing half of every raise to compounding looks like in real numbers. If you earn $60,000 to start and receive 3% annual raises over 15 years, your income grows by roughly $28,000. If half of every after-tax raise goes directly to investments instead of lifestyle, and those investments compound at 8% annually, you've added approximately $89,000 to your retirement balance from raises alone, beyond your baseline contributions. James did this, Marcus did not. That gap alone accounts for a significant portion of the $318,000 difference between their balances. The raise isn't the problem. The assumption that the entire raise belongs to your present life is the problem. Half of every raise belongs to the person you're going to be in 20 years, and that person has no voice in the negotiation unless you give them one in advance. Rule 3. Calculate the real cost before every major purchase, not the sticker price. Marcus bought his truck for $47,000. He financed it over 72 months at 6.4% interest. His monthly payment is $694. He thinks of the truck as a $694 per month decision. It isn't. It's a $694 per month payment plus $11,000 in total interest over the loan term plus $2,400 per year in insurance because it's a newer financed vehicle, plus $800 per year in registration and maintenance above what an older paid-off vehicle would cost. The real cost of that truck is closer to $1,100 per month when everything is included, and that's before calculating what $47,000 invested at 8% for 15 years would have become, roughly $149,000. Marcus didn't buy a $47,000 truck. He traded $149,000 in future wealth for a truck that will be worth $12,000 in 8 years. James drives a 2016 Honda Accord he bought used for $14,000 cash 7 years ago. It has 94,000 miles and has required $2,300 in repairs over those 7 years. His insurance is $900 per year because it's not financed and he carries lower coverage on an older vehicle. His total transportation cost, including repairs, insurance, registration, and gas, runs roughly $350 per month. The $33,000 difference between what he paid and what Marcus paid sits in an index fund. At 8% annual returns, that difference alone is worth approximately $104,000 at the 15-year mark. James doesn't drive an old car because he can't afford better. He drives it because he calculated the real number and decided that $104,000 in future wealth is worth more than a newer vehicle that does the same job. Before every major purchase, the question is not, can I afford the monthly payment? Monthly payments are designed specifically to make things that you cannot afford feel like things that you can. The question is, what does this actually cost when I calculate interest, insurance, maintenance, opportunity cost, and the compounding value of what that money could become over 15 years? When you ask the real question, most major upgrades answer themselves. Rule 4. Protect one number above everything else. James has never, in 15 years, touched his retirement account. Not during the job scare in 2019, not during the month his transmission failed and his rent went up simultaneously. Not during the period when his income dipped temporarily after a restructuring at a previous employer. He protected that number the way most people protect their rent payment, as a non-negotiable fixed cost of his financial life that simply does not get touched regardless of what else is happening. Marcus withdrew $18,000 from his 401k during a difficult stretch in his early 30s. He paid a 10% early withdrawal penalty and taxes on the full amount, losing roughly $6,300 immediately. But the real cost wasn't the penalty. The real cost was what that $18,000 would have become if it had been left alone. At 8% annual returns over 15 years, $18,000 grows to approximately $57,000. Marcus paid $6,300 in penalties and taxes to lose $57,000 in future wealth. That transaction, which felt necessary and even rational at the time, is one of the single most expensive financial decisions he ever made, and he doesn't think of it as a financial decision at all. He thinks of it as a rough patch he got through. The retirement account is not an emergency fund. It is not a savings account with restrictions. It is a time machine that converts present dollars into future wealth at a rate that no other vehicle matches, and every dollar removed from it loses not just its face value, but every dollar of compounding it would have generated for the rest of its life in that account. Build a separate emergency fund, 3 to 6 months of expenses in a high-yield savings account you can actually access, specifically so the retirement account never needs to be touched. The cost of not having an emergency fund isn't just the expense that eventually triggers the crisis. It's the compounding wealth destroyed when that crisis reaches the retirement account for a solution. Rule 5. Define what enough looks like before your income grows, not after. James decided early what his life needed to cost to be genuinely satisfying. Not the minimum survivable lifestyle. A genuinely comfortable, enjoyable life that he would be happy living for decades. He estimated that number at roughly $42,000 per year in actual spending, including housing, food, transportation, travel, entertainment, and everything else. When his income grew beyond $42,000 in take-home pay, the excess went to investments rather than lifestyle upgrades, because the lifestyle was already designed to be enough. He didn't stop enjoying his life when his income grew. He stopped needing to spend more on it, because it was already built to satisfy him at a level he'd deliberately chosen, rather than gradually drifted into. Marcus never defined enough, so enough kept moving. Every income increase became a new baseline for what felt normal. Every upgrade became the new standard to maintain. Every colleague's lifestyle became a reference point that quietly recalibrated his sense of what a reasonable life costs. He is now at 45, earning $80,000, and genuinely feeling like he doesn't make enough money, which is a statement that would have seemed absurd to the version of him who was 28 and earning $38,000, and thinking that $80,000 would solve everything. Enough is not a number that arrives on its own. It is a decision you make deliberately, before your income grows into it, and before your lifestyle colonizes every dollar of the increase. The person who defines enough at $45,000 of annual spending and then earns $80,000 sends $35,000 per year toward financial freedom. The person who never defines enough and earns $80,000 sends almost nothing because the lifestyle has claimed the entire income. Same salary, completely different financial trajectory. The only variable is whether enough was defined or left undefined. Rule 6. Measure wealth by options, not objects. There is a specific kind of freedom that James has at 45 that Marcus does not, and it has nothing to do with the number in his retirement account directly. It's what the number makes possible. If James's company restructures tomorrow, he can take 6 months to find the right next opportunity rather than the fastest one. If a better career exists in another city, he can consider moving without the calculation being impossible. If his health requires time away from work, he has the margin to take it. If a business opportunity arises that requires some financial risk, he can evaluate it on its merits rather than immediately dismissing it because he can't absorb any uncertainty. James has options. Options are what wealth actually is when you get underneath the number. Marcus, at the same age with the same income, has almost none of those options. His lifestyle requires his current paycheck. A job loss isn't a disruption. It's a crisis with a 2-week countdown before the payments start to fall behind. A pay cut for a more meaningful opportunity isn't a trade-off to consider. It's financially impossible. A health issue that affects his ability to work isn't a challenge to manage. It's a financial catastrophe without a clear solution. Marcus has built a life that looks impressive and feels precarious, and the precariousness is invisible from the outside, which makes it simultaneously more dangerous and more difficult to acknowledge. Every purchase is a trade against future options. The truck payment isn't just $694 per month. It's $694 per month of optionality exchanged for a vehicle that performs the same function a $300 per month vehicle would perform. The lifestyle upgrade isn't just more comfortable living. It's the permanent requirement of a higher income to sustain a life that has become dependent on it. Each individual trade feels small. The accumulated trades, made consistently over 15 years, produce the gap between $22,000 and $340,000, and between a life of genuine financial options and a life of financial obligation, dressed up as financial success. The 2 coworkers I described at the beginning will both retire someday. Marcus, if he changes nothing, will retire with somewhere between $60,000 and $90,000 in his retirement account, depending on how consistently he contributes over the next 20 years. At a 4% withdrawal rate, that produces $2,400 to $3,600 per year in retirement income. Social Security will help. It won't be enough on its own. Retirement for Marcus, the way things are currently tracking, will be a financial reckoning with a life he wasn't quite honest with himself about while he was living it. James, continuing what he's already been doing for 15 years, will retire with somewhere north of $1 million, likely significantly more if his income continues to grow and he continues to apply these rules to every raise and every major purchase decision. At a 4% withdrawal rate, $1 million produces $40,000 per year in retirement income, supplemented by Social Security, supplemented by the optionality to choose when and how retirement happens, rather than having the decision made by financial necessity. Same company, same salary, same 15 years. 6 decisions, made differently, compounded over time, producing outcomes so different that most people would assume they came from completely different financial starting points, rather than the same Tuesday morning break room and the same coffee from the same machine. The rules aren't complicated. They never were. Automate the gap first. Protect half of every raise for the future. Calculate the real cost, not the sticker price. Never touch the retirement account. Define enough before your income grows. Measure wealth by what you can choose, not what you own. These decisions don't require unusual discipline or exceptional income. They require making the decision once, building the structure to support it automatically, and then protecting that structure from the gradual, socially acceptable drift that consumed 15 years of Marcus's financial life without him ever making a single obviously wrong choice. You already know which of these two people you're closer to right now. The honest answer to that question is also the starting point for everything that changes from here. If this reframed how you see the gap between where you are and where you're heading, subscribe because we do this every single week. And if you know a Marcus who's about to spend another 5 years not running these numbers, send this to them before the gap gets any wider.